We've got a great report that we are going to be covering today, Tim. This is common planning mistakes or misconceptions. And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, your resource, ladies and gentlemen, proactive planners, savers, and investors for common sense on your money, your finance, your investments, and your retirement planning. He is Tim Stearns, CFP from TJ Stearns, Inc. Tim, always a pleasure to have you here on the program.
Peter, thanks for having me. It's always a good time to be here and educate the masses.
And we've got a great report that we are going to be covering today, Tim. This is something that 7 financial myths, common planning mistakes or misconceptions. These are actually things that a lot of people's financial future are based on. And it's not that they are always incorrect, but it's something that we need to carefully examine whether or not we want to count and depend on these financial principles generally accepted to hold true, or whether they are myths or misconceptions.
Well, that's why I like to talk about these, because I think a lot of people feel that these things are in concrete. What our preconceived notions of what the market does. And let's just lead off with the first one. The first one is the market always goes up, and then they always add eventually, right? One of the phenomenons that we saw in 2000 through 2012 is that basically the market didn't go up. It had gyrations where it went up, then it went down, canceling out those gains. And really, if you had put $100,000 in those 12 years, you would have been at about the same amount, about $100,000. Not to mention that if I'm retired at that point, what am I usually doing? I'm taking money out, right? Because I have to live. I'm a net seller of assets. So it comes down to the conclusion that, the market always goes up, not necessarily. And if that's your first 12 years of retirement, you better make sure that you have a plan.
Again, if you would like this report on these 7 financial myths, ladies and gentlemen, all you need to do is pick up the phone and give a call to TJ Stearns, 800-640-2256, 800-640-2256. I think that the reliance on any of these, Tim, are going to be something that we do need to question, hopefully ahead of time, not as we are experiencing the fact that these have not held true for us, but our results, our financial outcome, our confidence into and throughout retirement are only going to be as good as the assumptions that our plan depends on. And these 7 are kind of widely held beliefs and assumptions.
Exactly. And it's not your grandfather's stock market anymore. So the market, from 1980 through 1999, it had a nice clip to it, right? Market went up, but the last 23 years of the market has been kind of dicey. It goes up and then it goes back down and that type of thing. So when you're planning, you need to make sure that you have somewhere that you're going to be able to draw off of that's kind of like a fixed income, whether that's an annuity or some kind of a fund that you draw off of. Either way, the last thing you want to do is be counting on the market, because nothing is guaranteed in the market.
Yeah. And to be fair, Tim, the market has always come back, and not only come back, but surpassed previous highs. It's just, how long does that take? And if there is a protracted downturn or period of time where the market is not going up, a lot of people's plans and financial future basically depend on the market going up each year. That's what their projections show, and that's what their financial confidence entering into retirement is based on, but it's not something that we can count and rely on dependably.
No, you can't, because, every about 6 to 7 years, you have a retread back into a loss, a bear market on average. And I think the last 13 years up until 2022 got us kind of lazy and complacent, thinking that, the market will just continue to go up. That's not always the case, especially the phenomenon that we've seen in sequence of returns, which we talk about in my new book that we put out. And again, I'd like to offer out there to the first 10 callers our book, The Retirement Riddle. It really, I think, speaks to what's going on in the markets and what's going on for baby boomers as they try to retire.
Yeah. And again, ladies and gentlemen, great book, great resource available to you. Solving the Modern Retirement Riddle is the full name of the book. We commonly call it the Retirement Riddle. But we want to not only ask the questions that are plaguing today's retirees, but also prompt some rethinking on these and somewhat of these 7 financial myths covered in some form or fashion in that book. If you would like to get a copy that not only asks the questions and talks about the issues that are causing doubt and worry in retirement, but also gives the answers on the ways to rethink those questions to help build more confidence in retirement, pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Now, Tim, we look back at the American market and say, well, it's always come back. It's just a matter of waiting and how long it takes. But if we also look at Japan as an example, famously, right, Japan reached the peak of their baby boom wave of demographics in 1990. And if you think back to that time, Japan was widely considered kind of the model of efficiency, and their economic model was going to take over the world until they hit the peak of that baby boom demographic population. And then they experienced a prolonged, protracted market downturn. It's been now more than 30 years, and they have still not come back to recapture those highs. Not that the American economy is the same as the Japanese, but do we need to look at that and be at all concerned for that belief that the market always goes up or that it always will come back?
Well, I think you'd want to tread carefully as you go into retirement. A bird in the hand is what I would do. Try to make sure that you understand exactly how you're going to be paying your bills, rain or shine, meaning if the market is down, it doesn't matter to you because you've got some money allocated for that. Because if you're taking out money in a down market, you're really locking in those losses. And if the example that you gave in Japan at that point, I mean, the money's gone. You can't earn it again. And most of the people that we're meeting with in our office are either at the tail end of their career or they're getting into retirement. They just retired. So these are things that it's hard to make up that the losses. One of the things we show people is that, hey, your portfolio lost almost 30-something% in 2008. The good news is you were a lot younger. The bad news is if that happens now, it can be really detrimental to your retirement. So have a plan. And don't think that the market comes back all the time for you because you're going to be needing this money sooner than later.
A safe money strategy to complement the growth money strategy. The necessity for growth is obviously there, but also we want to protect what's important. And that is why we need to carefully examine this assumption that the market is always going to go up or even go up in the period of time that we need it to. And not only that it goes up, Tim, but myth number 2, that it goes up by a certain amount. There is this kind of widely held belief that the market averages 10% rate of return. The problem here and the myth or misconception that we are encouraging people to reconsider and rethink is that a lot of people's financial plans, and in air quotes there, and projections basically count and rely on the market growing 10% each and every year. And that's just not how averages work.
No, it does not work that way. And, when I first got in the industry in 1994, that's over 29 years ago, we were able to quote that to say 10% average return. And again, I'll say that 1980 through 1999 were great years for the stock market. Let's go a step further. From 2000 through 2022, the S&P 500, the very strongest of the companies that are out there, only average 4.477%. So how do I tell people that they average 10%? I think a lot of people have gotten away from that. But here's the other issue I have with some of these people that listen to the radio show or in our classes, they'll come to us with some kind of a projection that their other advisor did. And I ask them, have you ever had a stock market that always went up X amount? You've never had any retraction. And they're, oh yeah, I've had that. Well, then this doesn't really hold the water that it's supposed to. And I think that 10% is a very bold statement. It's 10% average return is nothing real to me.
Tim, this is 2 fronts then, if I'm understanding you correctly. Not only have we been taught and told that the market averages 10%, which over the last 22 years, the S&P has been a far cry from that,
Right.
just under 5%. So if over a 20, 25, 30, 35-year retirement, our plan and our financial future assumed and was based on averaging 10%, but then like the last 20 years, we got just about half that. We are a very far cry from where we intended to be. And that may alone really erode financial security and confidence, I would think.
Right. If you're starting to lose money in retirement, plus you're living on that portfolio, that would cause me to have a lot of angst and a lot of anxiety about how much longer can I do this. So that's why when you're doing an income allocation plan, we don't assume that. Really, we only assume 4 to 5% at most in our portfolios, because we're going to try to under promise, over perform. These people that are touting 8 and 10%, I think is a little unrealistic, and you need to be careful of that.
Which the Department of Labor agrees with you, Tim. They actually state that when planning for retirement, a 4% assumption is conservative, 5% moderate, 6% is an aggressive assumption for
Right.
what we will grow by into and through retirement. And then, Tim, the other factor is the returns themselves and how they are figured and how they are advertised. A mutual fund that advertises a 3-year or 5-year past performance of 10% may be very misleading if we are relying on that to know what actually happened with our money. And I think that this is another place where there is a big separation between the thought process and our understanding and reality and what actually happens with our money. Can you give us an example of where the past performance advertising of a mutual fund's rate of return of 10% may be misleading and what our results have been?
Sure. So let's pretend I have XYZ mutual fund. In the first year, it goes up 60%, which is pretty darn good. The next year, though, I have a terrible year and it goes down 50%. Okay. And then the final of these 3 years, it goes up 20%. In any order, what is your average rate return right there? It's, if you divide those numbers, it's 10%. So the issue I have with that is that if you actually take that out and extrapolate it, the average versus what you really returned is you're down to $96,000 off of $100,000 investment. So again, that's misleading when you give averages. I would want to look at what are the true numbers that came back to you. And I'll add in here that in that year that I'm going down 50%, do I need some of that money to pay my bills? If I do, well, I'm losing a lot more than that, aren't I? Which would lead me to the next point of the 7 myths of the market, the 4% rule. The 4% rule is something that came out from a gentleman in 1994. Now, remember, he had just seen the market go up from 1980 through 1994. He used a combination of stocks and bonds. And he said that if I took, let's say I had $1 million and I took out 4% a year, I would be able to not run out of money in that example. To this day, that gentleman, Bill Bengen, does not use his own strategy. In fact, he disallows it. It tells people not to follow that because it fails 67% of the time. So what I think a lot of people struggle with is what is a safe withdrawal rate? And 4% is definitely not it.
Yeah, we've actually had Bill Bengen on the program previously, Tim, and interviewed him about this. He said not only did it not account for the possibility of large losses very early on in retirement, but it also was always intended for an institutional investment, not an individual investor, meaning that his rule was dependent, Tim, on the law of large numbers, more for like pension funds, rather than one individual whose fate in retirement was dependent on following this rule. Now, recent changes in interest rates may have created some debate within this one, even though really, Tim, I think that the debate was already there. I was reading about the trouble with the 4% rule for many years in doing this program with you and how it was not reliable. But because interest rates have come up, maybe this one is a little easier. I guess I'll ask that in the form of a question. Is this cash flow that we can generate in retirement dependent on the interest rate environment?
Definitely right now, it looks pretty good, doesn't it? You have all these interest rates that are higher than they've been in quite some time, and that's great. But I will say this, they keep talking about the R word, and they've done that through all of 2023, recession. If recession does happen, these interest rates will drop like a hammer. And with that comes, people that were maybe thinking that they'll live off their money market at, 4.5% a year. They have to struggle to find another place to do that. That being said, right now, annuities have the best payouts I've seen in my career, so that you can lock in some of these withdrawal rates that are exorbitantly better than I've seen in my past history. So that's a great example of that. I don't think money markets and that type of thing will stay up concretely for that much longer. Again, if there's a recession, they'll move those interest rates down.
Well, again, if you would like the book, Solving the Modern Retirement Riddle, if you would like this list, this report of the 7 common financial myths, common planning mistakes and misconceptions to reconsider, or if you would like to sit down with Tim, certified financial planning professional Tim Stearns, CFP, and the team there at TJ Stearns Inc. to construct your own protect and grow written retirement plan, or to review your current plan, investments, and retirement accounts, pick up the phone and give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Again, for the first 10 callers to today's program with at least $500,000 saved or invested for your retirement, you can receive a copy free of charge of the new book, Solving the Modern Retirement Riddle. Again, that number, 800-640-2256. That's 800-640-2256. Tim, we've had several callers that requested that book, saying that, hey, they actually had even received the previous book that we often talked about on this program, Income Allocation, but didn't quite understand everything that was discussed in that book and wanting this one as the follow-up. A lot of people have benefited from the wisdom from the discussion in Income Allocation. A lot of people, I think, are really appreciating this new book, Solving the Modern Retirement Riddle. But there are a lot more out there that probably need this information, because there's a lot of concern about the prospects and the outlooks for retirement today, unfortunately.
Right. If you're out there and you're worried about whether you have enough money to make a go of a 30+ year retirement, I think the book really speaks to a lot of the things that need to be done inside of there. Social Security, Medicare, how this all intertwines with your retirement. That's all brought up in there. Also, kind of looking at active money management. The buy and hold to us is dead. So you need to look at a better way to do things, have stop losses, that type of thing. Active money management, I think, is where it's at now, and that's the type of stuff we talk in the book. We also bring up the A word, which is annuity. Some people say all annuities are terrible. I disagree with that. I own one myself, and most of my family members do. I don't have a pension, so where else am I going to get a consistent amount of money being paid into my family per month when I'm retired? Besides Social Security, and that, that's a nice payday, but you also need something else to augment that. So I practice what I preach. Having a plan like my wife and I do makes me sleep better at night.
And just a little bit of a spoiler alert, the riddle that is asked in that book, Tim, is if the status quo, if the modern systems and beliefs for planning for retirement were truly effective, if they worked so well, then would we see so much doubt and worry about our financial confidence and stability and quality of life in retirement, right? That is the riddle. And maybe, Tim, these 7 financial myths, these commonly held misconceptions to reconsider, maybe several of these are, in fact, detailed within that book as the reasons why, ladies and gentlemen, we are seeing that doubt and worry, because your outcome and your financial confidence is only as good as the assumptions that your plan is based on. And unfortunately, these widely held beliefs and financial myths and misconceptions are, in fact, the foundation for many people's financial plans or projections. And that's why we want you to learn more and potentially reconsider and question every assumption that your plan is based on. And again, if you would like to take a look at your plan and formulate a written protect and grow plan, bringing all of the pieces together, pick up the phone in, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, like number 4 on this list, taxes will be lower in retirement. Why is it that we need to question whether or not this one will hold true for us and is reliable?
Well, I can tell you really easily, the Tax Cuts and Job Act expires in the beginning of 2026. And as we've seen in Congress, they can't seem to get out of their own way. So I think that will happen. What happens then? The current tax rates, the income tax rates, are lower than they've been in since the 1920s. So this is a really great time to look at maybe Roth conversions and that type of thing. But getting back to the original question, taxes, I asked people in class, do you think taxes will go up after the end of 2025? I've had every person give me a thumbs up that it's going up. So what do we need to do about that? Well, we need to realize that we have income taxes are on sale right now. So you have the ability to maybe do some Roth conversions and take advantage of that. But they will be going up. And, like we talked about in previous shows, the 12% is going to go to 15%, which is only a 3% uptick, but that's actually 25% when you do the math on that. So we need to be cognizant of, your number one your number one bill in retirement will be taxes. And this is going to go up exorbitantly if they don't do something before the end of 2025. And I don't see them doing that.
Right. And Tim, we keep hitting these continuing resolutions on our spending limit, but we've got $33 trillion in debt. That's money that we've already spent that we've got to come up with from somewhere. That's from taxes. The government raises revenue from taxes, and they're already slated to go up. We know that Social Security Trust Fund has announced that they are short of funding and will run dry by 2033, only be able to pay 75 cents on the dollar is what is projected based on cash flow of tax revenue alone. So in all likelihood, taxes will be going up, but there has been a widely held assumption, Tim, in our planning process for really the last 30 years, the last generation that is now currently retiring or already retired, that taxes will be lower in retirement. Are you finding a lot of your clients are surprised by the amount that they pay in taxes in retirement?
Well, the way to know that is to actually quantify it. So we have a report that we offer to people. And I ask you out there, if you think you have a tax bomb in your portfolio, meaning most of your net worth is in your 401k, your IRAs that your partner for life, the IRS, hasn't touched yet. Do you want to quantify that? Give us a call and let us know, how we can get that for you. We will get the report to you. It doesn't cost anything, but it's definitely an eye opener. I think most baby boomers that I show that to are very surprised at how much they're going to have to pay in taxes, but that's part of it. We've been taught to save for the future. And by doing that, we've kicked the tax can down the street. So I'll ask you again, if you're out there and you think you have a tax time bomb, give us a call and we'll get you a report that can quantify what that amount is.
Yeah, if you'd like to take a look and see what your tax liability over your lifetime is likely to be, or what you could manage that for proactively. Eye-opening, the word Tim Stearns used, and I would agree, ladies and gentlemen, to see the difference in the cost versus what you could manage that tax bill for proactively is eye-opening, is astonishing oftentimes. And just what the bill projects out to be compared to what the balance is today is really eye-opening. So take a look at that report. If nothing else from today's program, get that tax analysis done on your tax-deferred accounts. If you've got an IRA, a 401k, a TSP, a 403b, any kind of tax-deferred retirement account, you need to see this tax analysis and report. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, we are not going to have time to get to all 7 of these financial myths today. So a little teaser here, but ladies and gentlemen, if you would like this list to review and evaluate all 7 of these financial myths, then pick up the phone now and give a call, 800-640-2256, 800-640-2256. And Tim, I'll give you one last opportunity here to talk about your new book, Solving the Modern Retirement Riddle, and why you think it's so beneficial for proactive savers, planners, investors, and retirees and pre-retirees to read.
Well, I'll tell you why, because I grew up with 4 baby boomers as my older siblings. So my 2 brothers and 2 sisters are all baby boomers. And, I've been around them my entire life, and I know what makes them tick, what makes them nervous. They're my clients. So obviously I have to, listen. And I hear a lot of angst as they were going into retirements. And I know that they needed to have a plan. And they needed also knowledge, and that knowledge is power. We've always said that in our family. So one of the reasons that I wanted to put out a book that was common sense, that didn't speak above people and didn't speak down to people either, just a common sense approach to how to get through a successful retirement. You only get one shot at that. And I have to say that I think the book kind of helps guide some people as to some different areas that we can help them with, or that they can help themselves with. But give us a call. The first 10 callers, we will be happy to get that book into their hands. The Retirement Riddle, it's hot off the presses. It's only 3 weeks old. So there's a lot of apropos material in there that I think is really good for people that are wanting to retire or even have started to retire.
Well, again, if you would like to get a copy of that in your hands, pick up the phone, be one of the first 10 callers with at least 500,000 saved. 800-640-2256. That's 800-640-2256 to receive a copy of Solving the Modern Retirement Riddle. And if you would like to proactively take a look at your plan, your investments, your retirement accounts, make sure that you understand what each and every dollar is doing for you, what its goal and what its job is, and make sure it's doing that effectively. If you'd like to understand the risks that you are taking with those investments, the taxes that you may be liable for, the fees that you are paying, how to optimize Social Security, so many aspects of the plan brought together so that you can see the full picture. That is what the Protect and Grow plan is all about. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. 800-640-2256. Or skip the phone. You can always go online, always available there. tjstearns.com. tjstearns.com. TJ Stearns is located conveniently in Arlington Heights, but Tim and the team can meet you wherever you are, whether in person in the office or with the ease and convenience of technology, virtually available that way as well. Just get the conversation started today. 800-640-2256. Tim, always a pleasure having you on the program.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.